There are five main benefits of passively investing in multifamily syndications: strong risk-adjusted returns plus diversification benefits, passive income, appreciation, tax benefits, and it's an inflation hedge. The first one is lower risk, greater returns. Perhaps the best advantage of investing in apartments lies in their risk-return profile. For decades, apartments have had the best risk-adjusted return of any property type, which means they have the highest return per unit of risk. Large apartment complexes have many leases, and each lease represents a small portion of the overall income. This gives apartments a distinct advantage over office, industrial, and retail properties, which have fewer tenants. Apartment leases are typically 1 year. This short-term lease structure gives the owner the advantage of adjusting rents upward more quickly in a tight market, or after making improvements to the property or the units, or lowering them during a downturn to maximize occupancy if necessary. Leases are also staggered throughout the year, so you don't have lease rollover all at the same time, like with other property types. The main reason institutional investors allocate capital to commercial real estate is diversification. A key metric of diversification is correlation, measured by the correlation coefficient. If two assets have a correlation coefficient of 1.0, they have a strong positive correlation. That means they move together. If two investments have a -1, they have a strong negative correlation, meaning they move in opposite directions. If two investments have a 0.0 correlation coefficient, they have no correlation at all. As you can see in the table at the top right, real estate has almost no correlation to stocks, 0.07, and a slightly negative correlation to bonds, -0.15. As such, real estate provides diversification benefits to a stock bond investment portfolio. Next, let's take a look at the table at the bottom right. This is the 20 worst quarters for a 60% stock, 40% bond portfolio from 1978 to 2012. In 17 of the 20 worst quarters for the stock bond portfolio, private real estate had positive returns. So now we know the link between returns to real estate and stocks and bonds is very weak. Lastly, studies have shown that apartments have been the most resilient property type during economic downturns, and they're the quickest to recover. Investing in apartments is investing in the basic need of shelter. People need a place to live, and there's a shortage of housing. As shown in our earlier stock market example, the average stock market returns over the last 23 years was 7.94%. But after taking into account volatility, fees, taxes, and inflation, the return dropped to 2.59%. On the other hand, multifamily syndications routinely deliver double-digit returns, and that's after taking into consideration volatility, fees, taxes, and inflation.